In just 1 year, big tech has spent roughly $400 billion building infrastructure for AI, not mainly to create the next ChatGPT, but to build data centers, buy GPS, secure electricity, install cooling systems, and run the massive machines behind the AI race. $400 billion. That is almost the total cost of 2 Apollo programs. But here's the strange part. While tech giants are announcing record-breaking AI investments, more than half of the AI data centers expected to open this year have quietly been delayed or canceled. So what is really going on? If AI is booming, why can't the infrastructure keep up? If GPU demand is so intense that NVIDIA can barely meet orders, why are so many projects still stuck on paper? And if hundreds of billions of dollars are being poured into this race, is this the foundation of a technological revolution? Or is it the first sign that the AI infrastructure bubble is starting to crack? In this video, we will look for the answer through 3 questions. Where are the chips going? Where will the power come from? And where is the real profit? If you only read the headlines, you would think the AI race is accelerating without limits. Microsoft, Google, Meta, Amazon, Oracle, and OpenAI keep announcing massive GPU clusters, giant data centers, and tens of gigawatts of future computing capacity. But behind those announcements, reality is getting stuck on something very basic: electricity. Many projects lack transformers. They lack transmission lines. They cannot connect to the power grid yet. Some are facing local opposition. Others have been delayed indefinitely. And this is the biggest paradox. Big tech is spending more money than ever on AI, but the infrastructure needed to turn that spending into revenue is not keeping up. When a data center cannot operate, even the most expensive GPS in the world are just machines sitting idle. In a gold rush, the people most likely to make money are often not the ones digging for gold. They are the ones selling the picks and shovels. In the AI gold rush, NVIDIA is exactly in that position. Many AI companies are still burning cash. Many chatbots have not yet proven they can generate sustainable profits. But NVIDIA is already making real money. Revenue has surged. Margins are high. And its stock has become a symbol of the AI era. The market believes in one simple assumption. The more AI grows, the more demand there will be for NVIDIA GPS. But the numbers are starting to diverge. Jensen Huang once said, NVIDIA could ship enough GPUs in 2025 to support roughly 10 gigawatts of computing power. Meanwhile, some estimates suggest that the total operating capacity of AI data centers worldwide is only around 7.7 gigawatts. In other words, the amount of GPUs being sold may already be larger than the total operating AI data center capacity in the world. The usual explanation is, that's fine. Plenty of data centers are still under construction. But in reality, many projects are not moving nearly as fast as the press releases suggest. On paper, they are multi-billion-dollar investments. On the ground, some are still just foundations, some still do not have electricity, some have not finished permitting, and some have already been delayed indefinitely. So where are all those chips going? Some may be sitting in warehouses, some may already be installed in data centers that cannot operate yet, and some may simply be part of advance orders placed to secure a spot in the supply queue. This is the bullwhip effect in the supply chain. When companies fear shortages, they order more than they actually need. Suppliers look at those orders and assume the market is booming, so they increase production. Eventually, the entire supply chain can become inflated, not by real demand, but by the fear of being left behind. In AI, that fear is even stronger than usual. No one wants to fall behind competitors. No one wants to be at the back of the GPU line. And no one wants the market to see them as the loser in the AI revolution. So they buy early, they buy aggressively. Sometimes they buy before they even know where those GPUs will be plugged in. That is not just demand, that is billion-dollar FOMO. There is a major paradox in the AI race. Big tech can buy GPUs much faster than it can power them. A GPU cluster worth billions of dollars, no matter how powerful, is useless without stable electricity, cooling systems, and a grid connection to keep it running. This is where the AI dream crashes into physical reality. The biggest bottleneck today is not just chips, it is power infrastructure. Transformers, substations, transmission lines, cooling systems, construction permits, and approval from local communities. On a spreadsheet, everything sounds simple. Build another 10 gigawatts of compute. But in the real world, the real questions are, where does the electricity come from? Who transmits it? Who approves it? How much will it cost to run? And will the people living nearby accept it? If even one of those answers is unclear, an entire project can be delayed for months or even years. That is why some data centers have already purchased GPS, installed equipment, and are nearly ready from a construction standpoint, but still cannot be turned on. not because they lack ambition, but because they lack power. This creates a major risk for the entire AI supply chain. NVIDIA can sell chips upfront, but its customers only make money when those chips are actually running. GPUs sitting in storage do not generate revenue. GPUs inside a data center without electricity do not generate revenue. And if the wait is too long, the expensive chips bought today may be overtaken by newer generations before they ever earn back their cost. In AI hardware, time is not just money. Time is depreciation. This may be the quietest risk in the AI boom. Expensive GPUs may lose value much faster than companies are showing on their books. Big tech is spending tens, even hundreds of billions of dollars on GPUs and data centers. But instead of recording the full cost immediately, companies spread it out over several years. That is called depreciation. For example, if a company buys $6 billion worth of GPUs and depreciates them over 6 years, it only records about $1 billion in cost per year. That sounds reasonable, but the real question is, will a high-end AI GPU still create economic value for a full 6 years? The problem is that the life cycle of AI hardware is getting shorter very quickly. The H100 barely had time to age before the H200 arrived. The H200 barely had time to pay for itself before Blackwell came along. And after Blackwell, there will be another generation that is stronger, faster, and more energy efficient. So a paradox appears. Companies say next year's chips will make this year's chips obsolete. But on their financial statements, they assume today's chips can remain productive for 6 years. If that assumption is wrong, the real cost will be higher. AI profits will be lower, and investors will have to ask, how much value are these hundreds of billions of dollars actually creating? The risk becomes even greater when electricity costs are added. Older GPUs are not just slower. They also use more power to do the same amount of work. As electricity prices rise, there may come a point where the cost of running a server is higher than the revenue it produces. At that point, the hardware is no longer an asset. It becomes a liability. GPU racks worth millions of dollars could go from strategic assets to electronic waste in just a few years. And that is the dark side of AI infrastructure. It is extremely expensive to build, but it may become obsolete much faster than financial statements suggest. To be clear, the issue is not that AI is useless. AI may still become one of the most important technologies of our time, but a great technology is not always a good investment at any price. The internet changed the world, but the dot-com bubble still burst. Railroads opened a new era, but many railroad companies still went bankrupt. AI may follow a similar pattern. The important question is not, will AI change the world? The real question is, can AI generate enough cash flow to justify the hundreds of billions of dollars being poured into infrastructure? Right now, the answer is still uncertain. Many AI companies are still burning money. Inference costs remain high. Users like AI, but they may not be willing to pay enough to cover all the costs behind it. GPUs, electricity, land, cooling, engineers, and debt. Over the past few years, cheap capital and private credit have helped the data center boom keep expanding. But if lenders and investors start becoming more cautious, that cycle could reverse very quickly. When confidence is strong, everything reinforces itself. New data center announcements, excited investors, more GPU sales for NVIDIA, rising stock prices, and more capital flowing in. But when confidence weakens, that chain can run in reverse. Data centers get delayed, GPUs sit idle, depreciation costs rise, electricity prices climb, credit tightens, and chip orders slow down. That is when the story of unlimited AI growth starts being tested by reality. So the fact that more than 50% of AI data centers have been delayed or canceled is not just a construction problem. It may be a signal that the physical world, power, land, capital, and time, is starting to push back against the growth rate financial markets once imagined. The most reasonable scenario is not that AI disappears. It is that the AI infrastructure boom will have to be repriced. Companies with real products, real customers, and real cash flow will survive. But projects built only because of FOMO, press releases, or investor storytelling may be forced out. No matter how impressive a data center sounds in a presentation, if it does not have cheap power, the right location, and committed customers, it will be very difficult to operate profitably. And GPUs purchased too early may become an expensive lesson. AI technology moves extremely fast, but electricity, land, permits, and transmission grids cannot scale overnight. The more companies race to buy GPUs, the greater the risk of oversupply. The more data centers get announced, the more pressure builds on the power grid. And the more capital flows in, the bigger the story the market needs in order to keep believing. But in the end, every growth story has to face one very practical thing: cash flow. The key question is, if tomorrow investors stop believing the promise that AI will make money in the future, how many business models today can truly stand on their own? In short, the fact that more than 50% of AI data centers have been delayed or canceled is not just a sign of slow construction. It shows that the AI boom is running into very real limits. Electricity cannot scale fast enough. Land is not easy to secure. Equipment supply is constrained. Capital is no longer cheap, and time waits for no one. NVIDIA is still the biggest winner in this race, but if NVIDIA's customers cannot turn GPUs into profits, even the seller of the picks and shovels will have to face a difficult question. How many people are actually finding gold? And how many are just buying shovels because they are afraid of being left behind? AI may be the future, but that future is not free. If it is built on stockpiled GPUs, overloaded power grids, and profits made to look better through accounting, then a major correction may no longer be a distant risk. It may be the market's way of forcing the AI boom back to reality. So what do you think? Is this the real AI revolution, or is it the biggest infrastructure bubble since the dot-com era? Leave a comment below. And if you found this video useful, don't forget to like and subscribe.